Well, Tesla was down 7.5% today, at worst about 10%, and my plan was to close out when price made a lower low and closed on the 1 hour chart. Somewhere was hopefully around $320. And in a worst case scenario, which does happen in this industry quite frequently, by the time that 1 hour candle closed, that had sold off nearly 6.5%. Now, some of you might say, hey, why would you wait until candle closure? And that's because my strategy and all of my trading bots are based off of candle closure. And it usually helps and makes things a lot better, except for a day like today. You'll see the first hour candle sold off to that low of $307. And if we zoom our way out, you'll notice that we're still sitting on the market bias. We're slightly under, but it's still holding green. Now, at this point, I was just going to close out the position, but I thought to myself, why would I do that from a risk standpoint? I got kind of stiffed holding in the first hour of market open, and I've already paid the bulk of the theta decay, the bulk of the downside. Now, theoretically, if if at the end of the week we don't get any bounce and we take a total of like a 16% loss, that's way worse than what we expected. But from this point, it's really not that much further. Now, is that specifically going to happen? Honestly, I don't know. Today's close was ugly, closed near the session low, BX Trender once again making lower lows, and as we said, the most unideal situation possible. But unfortunately, shit like this happens sometimes, and we know that this happens, especially when we're trying to time a market bias like this. Now, in a best case scenario, price ends up bouncing, closing this week somewhere around $320. That would hold on to the market bias. That would keep me in this position. That said, if that does not occur and we do end up closing at lows of the week, somewhere around this $299 level, I'll most likely remove my position off the table. Now, I do want to say that I do not plan and I have not averaged down on this position. We got in with the initial 20%. We added to our December calls. We ended up buying more calls this time for December 2025 a couple of days ago. And so there's no reason for me to just average down into this. That is how you lose way more money than you expected and potentially even blow up an account. And if we take that Fibonacci from swing low to swing high, we know that if this market bias 100% breaks, that this is going back down to $250, which will also line itself up with that monthly market bias. Now, before we go, I just want you to understand and remember why trading is so hard. Because when we look back at historical data, we're looking at numbers. We're not feeling the emotion. We're not feeling the sentiment in the market from other people. We're not feeling the pressure from the market or the worry when we're looking at back-tested results. And that's why this is so hard, because I promise you, each and every single time that price pulled back into the weekly market bias, it was never a pretty sight. It was never a pretty feeling. Things were not grand. But when we look back, it's so easy for us to sit here and say, oh yeah, the best time was to buy during the market bias. Look, it rallied. But remember, what you feel right this second is what you would have felt going long back here in October, going long back here in August. And it's what you would have also felt. So remember, this is why we use proper risk management and position sizing. This is also why we don't care about being wrong. Hopefully, price ends up bouncing. We close somewhere this week around 315 to 320. But worst comes to worst, we'll take the trade off the table and move on. If you want to learn my exact strategy, go check out our free course library. All of our trading content and courses are over there for free, but I do recommend starting with the Elite Traders Playbook, which will show you the exact checklist I use to enter and exit my trades, as well as how to set the indicators up.